Go and speak to one fairly significant FII into the Indian market. Sam Mahtani of F&C Asset Management, who runs a fairly significant portfolio in India, is with us now from London. Sam, morning. Thanks very much for joining in. What's your sense after the pullback of the last couple of days? Are we hitting some kind of an intermediate bottom, you think, out in India?
We actually believe we're pretty much close to the lows at the moment. And if anything, we think the outlook for the second half of this year and early next year is a little bit more positive. There's two factors really behind that statement. First of all, obviously the elections will be out the way, and we'll obviously have a new government in place who can obviously focus on policy. And secondly, we've obviously seen a steep reduction in interest rates and a very aggressive easing of monetary policy in India over the last several months, and we think that will find its way into the economy. And at some point this year, we believe the Indian economy will turn. So we're looking at the Indian economy potentially bottoming out and turning probably towards the fourth quarter of this year. So we believe the second half of this year and next year will be much more promising for investors in the Indian equity markets.
Sam, morning. Are you beginning to take a valuation call, though, on markets? And where does India fit in that context?
We think the valuations have actually corrected to very attractive levels in India. I mean, we've had quite a steep correction in the Indian market, obviously last year and obviously year to date. And looking at valuations now, the market's trading on around about 9 times forward earnings. We think that's very attractive if you look at that in the context of the last 3 or 4 years in terms of where the multiple has been. And certainly at a bottom-up level, we're finding a number of attractive investment opportunities at this type of valuation. So we are finding very good companies such as Reliance Industries on single-digit multiples with high earnings growth forecast for the next 2 or 3 years. So we think it's a very attractive time from a valuation perspective to look at India.
While that may be true, Sam, the problem has been with technicals, and there's been relentless selling over the last many weeks from foreign investors such as yourselves. Do you see that continuing, or do you see that abating as we go beyond March?
Clearly, some investors in the international marketplace have been a little bit nervous about India following the underperformance. Our investors have taken a bit more of a longer-term view about India. They obviously are... They believe in the India story and the economic story out, with growth rates of potentially 6 to 7% in the longer term. But certainly, obviously, in the marketplace, we've seen, as you know, net foreign selling of around about $2 billion in the Indian marketplace. So clearly, there has been some redemption pressure on Asian and emerging market funds. But our investors are taking a slightly more longer-term view on India at the moment, and we've not seen much redemption pressure over the last few months.
There is also a fear, though, Sam, that our market might lag the performance of other markets because we've got elections, and politics usually is something the market is nervous about. How do you feel about that part of it?
I think possibly over the next 3-4 weeks there could be some volatility around the elections. Obviously there'll be polls coming out, and people will be speculating which of the political parties will come in with the coalition. But I do think that once the actual national elections are out the way, we'll get I think investors will feel much more comfortable with the India story again. And I think we've seen in the past there has been a little bit of volatility in the past several elections up until the elections. But once the elections are out the way and we have a government in place, I think the elections are very much just a short term we may see some short term uncertainty, but we think things will look a lot better once the elections are out the way.
Let's talk about a few sectors now, Sam. Banking, which has been the worst dog over the last many weeks in our markets. Do you see value in banking stocks, particularly leaders like State Bank of India, or do you think they will continue to be pinned down by these mounting NPA concerns?
Everybody's been concerned about the NPAs in the banking sector. We actually think that the sell-off that we've seen over the past week does look a little bit overdone, although you've got to be very stock-specific in terms of the names that you look at. So the one stock that really stands out, in our opinion, is State Bank of India. That bank has got a huge franchise, as you know. It's got around about 20% market share. It's got 12,000 branches, so a huge deposit, franchise capability. They're expecting loan growth to be fairly strong over the next year or so. They're expecting margins to be stable. and they've got a relatively decent ROE in the current environment of around 15-16%. But that particular bank is trading on 0.7 times book, which we feel is very, very undervalued at this point in time. But what we'd say is that you've got to be very stock specific. As I said, you've got to be a bit careful about some of the banks which were very aggressive in their lending over the last 2 or 3 years, like ICICI Bank. We would focus on, again, those banks which had more conservative lending policies, and again, which have got strong franchises like State Bank of India.
Last we spoke, Sam, you were quite positive on capital goods stories like BHEL and L&T, but the earnings over there have been under a cloud. How are you feeling about stories like that now?
Well, we're still very bullish on BHEL. We think it's got a fantastic franchise and a very strong thematic. As you know, a lot of the infrastructure spending in India is going into power generation. The benefit that BHEL have is obviously, a lot of their projects are funded by the state or national government, so there's no problems in terms of the current credit crisis on their orders, and obviously they've got a very large order book. We're very confident about their ability to execute over the next couple of years, so we think it's a very high growth story, which is very attractive in this environment. On L&T, we are more cautious because of the fact that obviously a lot of their capex spending is related to private sector capex, and obviously with the credit crisis we're seeing in India and globally, there is obviously it's a lot more difficult to access funds from banks and lenders. So obviously they've got a good order book which will see them through for the next sort of 18 months or so. But we do feel that their order intake will slow down post that with the current credit sort of scenario in the markets.
Let's move to the oil pack now, Sam. Where do you stand on that, both upstream and downstream, the listed companies out here?
The oil and the energy sector, really, we would highlight Reliance Industries and Cairn as the two key plays. With Reliance, we're very comfortable and confident about their ability to grow their earnings over the next couple of years. Obviously, they've got two big projects helping to drive the earnings picture there, Reliance Petroleum and the KG-D6 gas basin. And we're very confident on their execution capabilities with those two projects. And as I said, they're going to help drive the earnings growth there. Again, Cairn has the Rajasthan project coming on stream at some point this year. It's a stock we've liked for the last year, and we still continue to like that stock and have an overweight position there. We would be a bit more cautious on the public sector companies, obviously, as you mentioned, because of the subsidy issue, but also because of the fact that there's not much growth taking place there. So, we think the ONGC story looks reasonable from a dividend sort of type of perspective. I mean, the yield is quite strong, but there's not much production growth. But we'd be underweight the oil marketing companies, actually. We still think there's regulatory, risk, and, there's not much growth there. So we're underweight the marketing companies at this point in time.
The odd one in the heavyweight list, though, Sam, is IT. I mean, everyone is cognizant of the concerns on the sector, but Infosys has barely broken 1,200 at any point. How are you feeling about that sector?
We actually like the Infosys story, although clearly on the technology side there is some concerns about the pressure on budgets, on corporate budgets, in particular the US corporate budgets. But we are cautious on some of the other IT names, but we do have a strong preference towards Infosys because we believe they can actually manage the current environment and they can get through the current environment. We think that they've got, again, a very strong business model to help them get through. They can certainly take some action on the cost side to help maintain their margins. Obviously, they're a beneficiary of the rupee weakness as well. So we're actually quite positive on India, on Infosys, on a 12-month view. And we think that's the clear standout stock to own in the technology sector at this point in time.
Very good speaking with you, Sam. We appreciate you taking the time out for us today. Sam Mahtani talking about all the stocks and sectors that he likes right now. Let's